Welcome to today's episode of the Capitalist Investor. You have me, Cool Hand Luke, and you have TZ, Tony the Tiger.
Yeah, baby.
What up?
Yeah, again, Derek on assignment.
You got
Jealous.
Yeah, always just
jealous.
gone and doing something.
I know, man. Jet setting. Jet setter. He's like Ric Flair of The Office.
Woo! Woo! So we have a pessimistic topic today, which maybe could be optimistic if you change it to that, but we are talking about bankruptcies. We're talking about bankruptcies on large corporations, small businesses, and specifically notable bankruptcies and kind of the story it tells for the environment we're in and what's going to happen going forward. So, I'll start off by saying, over the past, maybe let's call it this year, 2024, maybe even the past year, end of last year, is there anything notable, Tony, like big names, firms that you've seen in the headlines? You're like, that's interesting. Like, they went bankrupt? Like, I was not expecting that. Anything that you've seen?
Well, all right. So let's just take a look at the numbers. I know that you made mention that, small businesses are up 60%.
Yep, year over year.
Year over year. I saw a statistic that bankruptcies are up 16% year over year. But we are still at pre-COVID lows. So there's not as many as there was pre-COVID.
Right.
But you and I are talking about the rate of change.
Yes.
Like, it's starting to accelerate.
It's like the unemployment. We go back to the unemployment rate. Like 4.1% unemployment's historically extremely low. But the fact we rose from 3.5% to 4.1% in a matter of a couple months, the rate of change is concerning. Same thing with bankruptcies. How quickly it's starting to turn. Yeah. It's like, is this a signal for the future?
And if you don't, exactly, is it a signal? What is being done to help decelerate those rates of change, either slow it down or stop it or whatnot. But it is concerning, and there's a couple companies that came to mind. Infamous Red Lobster's going out of business, but they had $1 billion in debt, and you can't have all you can eat shrimp anymore. Okay, I mean, I don't know how you didn't see the writing on the wall on that one, but that's what they claim. The problem was like, oh yeah, the endless shrimp buried us. Like, so they have $1 billion in debt. Like, that doesn't happen over a quarter, a year, or 2 years. Like, that's a lot of debt.
So from my understanding, and I want to just dig into this one specifically very quickly. From my understanding, like a PE private equity firm came in, like whooped up, like bought up Red Lobster, and they separated the companies into two. And like, you basically had the restaurant Red Lobster, and then you had the real estate Red Lobster. So essentially, the Red Lobster restaurants went out of business and bankrupt, essentially, is what's happening. But their real estate business is still operating. So basically, they're wiping out all the debt the restaurant has, but they're keeping the real estate. So this private equity firm's coming in there and actually making a ton of money because they're keeping the real estate side, and they're going to be able to flip that real estate or do something with that real estate.
Are they really, though? Like, the commercial real estate is not selling. There's a lot of restaurants going out of business because, I don't know, it's just like, it's too expensive to go eat, right? I mean, I know it's weird. I was having this conversation. It's always like Longhorn has to be killing it. They're always busy. Texas Roadhouse always
those damn rolls,
always in that butter, that like cinnamon butter. Yeah. Just swimming that stuff, man. I have one friend that says they go up there and just ask for 2 tubs of butter and take it home. But anyway,
that's what I would do.
But so as these restaurants close, I think less people are actually going out to eat, or maybe just Red Lobster's just seeing its time. Like, they just lost their. There's more steak and burger places opening than seafood places. Yes. Like, maybe the new palate is not seafood.
No, it's chicken wings.
It's chicken wings and burgers and smash burgers and steaks. All right.
It's
so
American way.
Honestly, it could just be a trend. Maybe it's not them in general or something they did. It could just be a trend that they couldn't stop.
Yep. So you have.
But this whole real estate thing is. That blows my mind because, I mean, look at Macaroni Grill. I think they closed too. They're empty still. The ones that I've seen go out of business, there's nothing new jumping in there.
Well, it's like not to get too off on just one tangent here, but like the McDonald's is kind of similar to how Red Lobster probably was built. McDonald's is not a restaurant company. It's a real estate company. The whole movie, The Founder or whatever it be, it's a great movie. Talks about how McDonald's, like, was all built on the real estate, and they franchised it all out. But they own the underneath the real estate. So really, it's a real estate company.
Yeah, you have to
Red Lobster is the same kind of deal.
You got to lease the land, and that's how the company makes money, not from food sales and things like that. Yeah.
So, but the key thing you hit on there is the amount of debt, right? So the $1 billion in debt, and a lot of companies.
Just one company,
well, a lot of companies though have tons of debt. So Express was another one.
Yep.
You know, they're a apparel brand, usually for younger, I think 20, 30.
Right. And so there was another company, Brew 2021. So they're kind of grouped in the same thing. It's like that consumer discretionary, teen shopping. But I mean, you should know that's such a risky business. I remember when I was younger going to like merry-go-round or what, like these different chains to get certain clothes, but as soon as they're not in style, they went out of business.
Yes.
Chasing a teen's desire to dress is gotta be hit or miss.
And margins are thin.
Margins are thin. Wallet share, inflation. I mean, I would assume that the majority, maybe not all, but the majority of teens buying clothes comes out of their wallet. Maybe they're out of their parents, but maybe some of them do have jobs, and they got to go buy their own stuff.
Kids have jobs, really?
I don't know.
I don't know. Not in this environment.
Another type of company that's been going out of business is solar, and we've talked about that with like just investment themes where wind and solar just are not ready for prime time use. Technology, the amount of energy to create the energy is almost a wash, or the technology is just too expensive. So solar, I'm sure, is very efficient because you're just collecting sunlight. But when you start having to pay for that technology, it's not cheap.
It's really the battery technology that's not there. So like solar, you need to store that technology after it's...
So the converter?
Exactly. Yeah. So the conversion to the battery and the battery storing it, that's not there yet. Right. So this is where you have the government coming in, incentivizing these sectors that aren't ready yet, that, when they will be 10, 20 years down the road, free markets will be ready for that to come in. So you're seeing a lot of solar companies that took on a lot of debt, got a lot of investment come in, but now their demand's not there because free markets are saying it's not ready. But
it's also what from my understanding, that's definitely one thing. They can't, like, all the things the R&D to get the technology is definitely expensive, but like then you have to find the consumer that wants to buy it, and it's not cheap. So then they therefore go and finance it. Yep. And when you have to finance at 5 to 10%, it's not cheap.
I had somebody, not to get too off topic here, I had somebody tell me that mainly solar companies, and the way that it's kind of the economics and financial engineering works, it's almost like a money laundering scheme. I had someone tell me that because of the tax incentives.
Yeah.
So like you literally get a new solar roof, you basically can get it for free because of the tax incentive. So all the companies are doing are using government-funded money to go in there, and they're collecting checks from the government, not the free market.
That's what we were doing with EVs, dude.
Well, let's talk about that.
So when you were getting $5-10 grand as a rebate, guess what? The EVs are $5,000 to $10,000 more. It was a bad idea to give the incentives for EVs because all of the automakers just jacked up the rate.
Well, you're seeing EVs now go bankrupt. Yeah. Fisker just filed bankruptcy.
Fisker was a good-looking car, actually.
The Ocean was a good-looking car.
It was a
SUV.
Yeah, and they're like sport, like they're sedan. I'll tell you what. I think the majority of EVs actually look really cool because the design, like they don't have an engine, right? Like it's not as I want to say they're not as heavy, but they are. But like they can make them look really cool. Like the Porsche EV looks phenomenal, the best looking Porsche they might have, in my opinion. And like, I that's why it's always been boggling to me, like how I don't think Teslas are that good looking of a car. Honestly, and they haven't really changed the design either.
So the buyer of
but that's probably a smart person like Elon is. I don't care what it looks like as long as it runs and it runs efficiently and the technology. Like he's not thinking of like the other emotional side of it. Like, man, it's a sexy looking car, or it's not.
At the end of the day, I think you're seeing a lot of now the turnover in electric vehicles. So Fisker's one of them. You have like Lucid out there, you have Rivian, you have all these other ones that have so much debt out there. But the good thing is about like Rivian, you have Amazon backing them. You have like, I think Lucid, you have like the China, and you have also like the oil, Middle East, like the funds over there backing it. So you have still this money pouring into some EV areas, but like I think the majority of these small EV companies are going to be bankrupt in the end. Like, there's just
Yeah.
not enough demand right now
Right.
to keep them going. So that's one other area that we just hit on there, the electric vehicle side. Other thing that I've witnessed the past month, lumber liquidators. You saw it go bankrupt just like last week. They're LL Flooring, so they have a ton of debt outstanding, and people aren't, building houses as much anymore. You've seen home sales down a lot, renovations are down a lot. You saw Home Depot come out with earnings.
The home sales stuff is that, like, there's starting to become a backlog of new homes.
Right.
That's crazy. Like, I can't wait to see how this really shakes out. You have no one selling their existing home, and then you got a bunch of new homes out there. Maybe they'll sell when interest rates come down, but I'm imagining these builders are going to take such a haircut to move a house, right? Because they're sitting on a high inventory.
Yeah,
according to a lot of reports I'm reading. But
these new houses too. A lot of these home builders are financing the houses through themselves. So I'll give the example of my cousin just built a house in Columbus area, and the reason why they were able to get a little bit discounts on some things was because they went financing through their company. So basically, these companies are acting as the banks.
Right.
So that's
that's how they buy down the rates, and they do all of.
Well, that's a good thing as long as people are able to pay back to them. The problem is what happens
you don't want to be the bank.
Well, what happens if you're the bank and shit hits the fan?
Yeah,
that's the thing you want to pay attention to.
So if you're looking to invest in home builders, maybe you want to look for the ones that are not doing self-financing.
Correct. That's
where they're trying to get current revenues moving and not having the foresight of, oh man, look what happened. There's a recession. Oh, people are losing their jobs. Oh, they can't make their mortgage payments. Oh man, I'm done.
No one thinks about that.
So
right?
At the end of the day, a lot of these bankruptcies, obviously keeping up with trends and wallet share and in online marketing versus brick and mortar, those are all things. But at the end of the day, what I'm really seeing with all of this is the cost of borrowing money. Interest rates are starting to really squeeze.
Yes.
Margins on every level for every business. When you were borrowing rates at 1%, 2%, 3%, and now it's 8 or above, that's a big problem.
Huge.
And those little things are catching up.
Yep. And then you have, I'll throw out one more just because my mom used to sell it, Avon, right? Yeah. Everyone knows the cosmetic brand Avon because when I was growing up, everyone's and their mother seemed to be, including my mother's, used to sell it. So, you have lawsuits, like Avon is dealing with lawsuits.
Avon parties, Tupperware parties.
Yeah.
Just think that the Mary Kay people of the world are probably salivating right now.
But I think they have lawsuits that some of their cosmetic brand like cause cancer or whatever it be. There's something there. So like then you have this high interest rate environment to these companies where it's hitting margins, but then you also have potential lawsuits. So it's like all these unknowns, like whether it's lawsuits, interest rate, debt, hitting margins, like there's a bunch of unknowns out there for companies that a lot of companies didn't prepare for. So again, hitting on your topic that you just brought up, everyone, is trying to make money when times are good, but when times are bad, no one kind of prepares for the times bad. Yeah. And the question is, are we entering into a bad period? And how much, if we are entering into a bad period, how much of these fluff companies are going to be wiped out?
Yeah.
So, I think the rate of change is important to bring up. I don't think this is the end. I think this is somewhat of the beginning of a bigger kind of wipeout. The Federal Reserve, I've spoken to them this before. The Federal Reserve was created for two reasons: to bail out things and to break things. And right now, they're breaking things. And essentially, it's doing what it was designed to do. They wanted to break things to cool off the labor market. They wanted to break things to cool the economy from inflation purposes, right? So the two questions out there is how much are things going to break? And when things do break, what are they going to do to interest rates?
The base case is still a soft landing. So maybe we'll talk about that in a different podcast about what does a soft landing look like? What does a hard landing look like?
What does a no landing look like?
Yeah, let's just stay in the air, right? So, all right. Well, again, thanks for listening to us. It's like all the implications going on with small businesses and their bankruptcies right now. What does it really mean? Why is it really happening? So hopefully shed some light on that. As always, if you have a topic or a question, you can always hit us up at info@swpconnect.com. But other than that, have a great day, and we'll see you in the next episode.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.